morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, earnings season continues apace, and today we're taking a look at two very popular and well-known brands in Trinidad and Tobago. We're talking about Scotiabank Trinidad and Tobago and the West Indian Tobacco Company, WCO, of course. So both companies have reported earnings. In the case of Scotia for its first fiscal quarter of 2022, and in the case of WCO for its full year 2021 results. Different fortunes. Let's take a look at how both companies would have done during their respective financial periods, turning firstly to Scotiabank Trinidad and Tobago, SBTT. Well, the group would have reported an earnings per share figure of $1.05 for that first quarter 2022, which was a 27% increase from that 83 cents in the prior comparable period. Now, net interest income was still challenged, down just around 3.7% from 317.4 to 305.6 million. Overall, however, total revenues were up just around 7.6%, bolstered by increases in other income. Non-interest expenses were also down from 200 million to 173.5. So Scotia doing a good job in terms of its expense management. Net impairment losses also down 24.6%, and overall income after tax up from 146 million to just under 186 million for that first quarter period. When we take a look at the revenue trends of Scotia over their comparable past few first quarters, we see that after a fairly steep decline in that first quarter of 2021 of 7.3%, Scotia has bounced back fairly nicely, up that 7.6% over a comparable quarter. Again, net interest income in this purple color down just at 3.7%. Other income, however, would have more than offset that decline, moving from 124 to 169 million, or roughly 55% increase. So certainly some positive trends for Scotia, and certainly welcome news for Scotia investors for this first quarter result. Looking at the trailing earnings per share and price earnings trend for Scotia, however, we see that there has been a bounce back in that trailing earnings per share figure to about $3.64, which lines up quite comparably to the first quarter of 2019 and first quarter of 2020 trailing EPS, which was in that 360 to 380 range. However, investors are paying more per dollar of earnings generated by Scotia at the moment, as indicated by its price to earnings ratio, which has ballooned from around 16.5 times in that first quarter 2019 period to its current level of 21.4 times. But the stock does, at a price of $78, as mentioned, offer that price earnings ratio to investors fairly expensive relative to the banking sector of 21.4 times compared to the banking sectors and just under 19 times. But Scotia does offer as a stock a fairly healthy dividend yield of 4.6% on a trailing basis. Now, on the basis of lower credit impairment losses, consistent dividend payments, but currently pervading volatile financial markets and those fairly lofty valuations, Bourse is going to maintain a market weight rating on Scotia for the time being. Turning quickly to WCO, the West Indian Tobacco Company Limited, the group would have reported an earnings per share figure of $1.50 for fiscal 2021, 7.4% down from the $1.62 reported in fiscal 2020. Revenues were down yet again 5.3% from 900 odd million to just around 850 million. A fairly good operating margins would have led to operating profits, however, still remaining fairly resilient, but down nonetheless from 587 to 587 million, and profit for the period ultimately fell from 410 to 379 million. So certainly not very good reading there. From a revenue story, we can see WCO continues to confronted several challenges over fiscal 2021, with an acceleration in revenue decline in fiscal 2020 down 3.8%, in fiscal 2021 down a further 5.3%. So we can see that there has been a downward trend. And again, fiscal 2021 was interrupted severely by the closure of multiple distribution channels, such as bars, casinos, and of course, the absence of fets and other public engagements and outdoor engagements. Now, WCO's shareholders and investors have responded fairly surprisingly. Despite this, the company paying a still healthy dividend, although decreasing, the share price has fallen at a much faster clip, as well as a faster clip than earnings. And we can see that on that trailing basis, with the earnings per share of $1.50, that price to earnings ratio has fallen fairly significantly over the past 2 years, from 25 times in fiscal 2019 down to 22 times in fiscal 2020. and now 16 times in fiscal 2021. Now, at a price of $24, Wipco is trading at that 16 times price earnings ratio, which is fairly significantly below the sector average of 35 times. However, that sector average would also be inflated by underperformance of other companies, but it still does pay a fairly attractive dividend, also of 5.9% on a trailing basis compared to that sector average of 3.6%. So certainly a stock to keep in mind for those investors really focused on income generation. So on the basis of attractive valuations, fairly good operating on continued operating efficiency, relatively strong product pricing power in terms of the goods and services it produces and sells, notwithstanding the competitive pressures of competing products. Bourse is going to maintain a market rating on Wipco for the time being. That's it for this week's edition. For more information, give us a call at 2BORSE or 226-8773. Email us at invest@boursefinancial.com. And you can catch all of our investment research on bourseinvestment.com, which is absolutely free, and also in today's business section of the Trinidad and Tobago Guardian. Stay safe, get vaccinated, and we'll see you next week on the Bourse Report.